Welcome to GRE. I'm your host, Keith Weinhold. Vital trends are moving the rental real estate market, and learn what really drives rent growth. It's probably not what you think. Then, inflate, baby, inflate. Why this administration wants inflation. Today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE from Whippany, New Jersey to Parsippany, New Jersey. Not much distance there. And across 188 nations worldwide, I'm Keith Weinhold, and you're listening to this week's episode of Get Rich Education, where it's not just about your ROI, it's about your ROTI, your return on time invested, and your return on life. Everyone says that population growth is what drives rents. Yes, but that's just one part of it, and it probably isn't even the most important factor. There is evidence of this from Harvard research to what HUD has found. Austin, Texas recently added 500,000 people, rents spiked, and then supply flooded in, and rents stalled. Head count wasn't enough. I discussed that in depth when I walked the streets of Austin last year. San Francisco lost population, but yet rents rebounded and remain among the highest in the nation. Harvard's housing research shows that population growth only has a weak correlation with rent growth. So what actually does drive rents? Well, income growth, supply constraints, and then staying under the 30% affordability ceiling, which is HUD's definition of what a cost-burdened household is. All right, that means that a tenant spends more than 30% of their income on rent. That is cost-burdened. And this pattern holds from ancient Rome to modern Manhattan. Rents follow paychecks, not head counts. And on the supply side, well, not all metros are created equal. Some have quantified it with what's called a supply elasticity score. Places like Houston can seemingly build endlessly, while Manhattan and San Francisco cannot. So it's that difference that explains why incomes turn into rent growth in one market, but not in the other. So if you're chasing fast-growing metros, okay, but be careful because headcount does not equal pricing power. Paychecks are what do. Well, today, rents are falling in boom towns, but they're climbing in what we would call legacy, established metros. The year-over-year rent change across U.S. metro areas really has a striking contrast. The three with the fastest rent growth are San Francisco, up 4.6%, Fresno, also up 4.6%, and Chicago, up 4%. And the three biggest declines in rent are Austin, down 6.8%, Denver, down 5%, and Phoenix, down 4.1%. Rent contraction in those three cities. And here's the problem. During that 2020 to 2022 real estate surge years ago, investors piled into Sunbelt markets and they sort of expected this endless growth. But then new supply flooded Austin, Phoenix, and Denver, pushing rents down and vacancies up. And all three of those are cities that I visited during the boom, and I saw the cranes in the air myself. And yet at the same time, older, supply-constrained metros like in the Northeast, in Chicago, and in San Francisco, they are quietly regaining momentum. That's where demand is steady, construction is limited, and that's why rents are ticking higher. So this is why, like I've talked about before, it's good for you to invest in some Sunbelt areas, say like Florida, and then others that have this steady demand, like, say, a place in Ohio. And it's worth pointing out, too, how unusual it is that a city like Austin has a 6.8% rent contraction. We all know that housing prices are more stable than stocks, sure, but real estate rents are even more stable than housing prices. So this rent aberration, that was caused by such wild overbuilding in Austin. Now, I recently attended a presentation on the rental housing market. It was put together by John Burns. He's the one that presented it, and he's the owner of the eponymous John Burns Research and Consulting. And people pay good money to attend these presentations, and he's a guy worth listening to, always with good housing market insights. And some of his insights, well, they're the same ones I've shared with you for a while, like how there's been a persistent lack of housing supply in the Northeast and Midwest, and still an abundant supply in the South. The Northeast is the only region of the nation that's adding more jobs than new homes at this time. The top amenities that tenants want today are a driveway and a yard. Pretty simple things. They're not a pool and a clubhouse. They're a driveway and a yard. And if you think about that, it totally makes sense. And that's why single-family rentals have become such a booming industry, because that's where tenants are getting a driveway and a yard. And Burns also pointed out that most U.S. job growth is in low-income jobs. The presentation talked mostly in terms of headwinds versus tailwinds. Lower immigration, well, that's a headwind. That's a bad thing for real estate investing since immigrants tend to be renters. The tailwinds, the good thing, that includes less future supply coming out of the market, fewer apartments and fewer build-to-rent deliveries coming online, fewer being added between today and 2028. And another positive for the next 2 decades at least is the fact that since people are having fewer kids, that makes people less likely to settle down, buy a home, and need a good school district. Well, that is good for people renting longer tenancy durations. And John Burns also spotlighted how building material cost inflation is up 40% from pre-pandemic times, fully 40% more in material costs. But that spike has since flattened out. However, it is just another reason why home prices can't really fall substantially. Today's prices are baked in. And his summary overall is to be bullish and bet on the tailwinds, those real estate investing positives. That is mostly due to future rent growth because the new supply is going away and it's going to continue to stay difficult to buy a home. More rent growth. And that's the end of what he had to say. So as you're out there targeting the right areas and renters for your properties, I've talked before about how new build rental property is a sweet spot since your builder will often buy down your mortgage rate for you. New build is where you can attract a good quality tenant. Look, for a moment, just forget finding a tenant that can just barely afford your unit because they're spending 30 to 33% of their income to pay you rent. Because see, in that condition, there's no room for you to get a rent increase. If you can offer great value to your residents and target a 10 to 15% rent to income ratio, oh, you are really in good shape. Because the easiest rent growth is retaining happy residents that are conditioned to accept 5% rent increases. Well, that is more likely in a nice new build property. That's where you attract a better tenant. And if they were to move out, they would have to take a lesser property. So they will stay and pay the rent increase. and they're going to have the capacity to do so when their rent is only 10 to 20% of their income. Now, when we talk about a major factor that trickles down to rents, the level of inflation, a lot of this comes down to the Fed chair and even the president to some extent. And you know what's interesting? Half the nation bashes whoever is president, and the entire nation bashes whoever is the Fed chair. Look, every recent Fed chair has been maligned and bashed more than a piñata at a toddler's birthday party, bashed open more than an umpire at a Little League game. Well, since 1980, there have been 5 of them: Volcker, then Greenspan, then Bernanke, then Yellen, and now Jerome Powell. Most of that group is known for substantially lowering interest rates, yet they've remained unpopular anyway. And you know the irony here? The most popular of these 5 is Paul Volcker. He's the only Fed chair that's celebrated, and yet he jacked rates in the 1980s to up near 20%. Yes, 20%. He really made borrowers feel the pain, but yet he's the only guy that's celebrated because that's how he stomped that out-of-control inflation fire 45 years ago. In 1981, mortgage rates peaked between 18 and 19%, yet somehow he's the Fed chair that we celebrate. Well, here in more modern times, will the Fed eventually have to do the same thing? This is because Trump wants inflation. Now, the short-term talk is about lowering interest rates, but there are so many inflationary forces that you've got to wonder about how interest rates could very well go much higher later to get on top of this inflation that I'm telling you Trump actually wants. Now, of course, no one is going to come out and explicitly say that they want inflation, but that is now so implied. There are a ton of policies that the administration favors that are super inflationary. Some are a little deflationary, like deregulation, but they are overwhelmingly inflationary. Look, tariffs, that's inflation on goods. Mass deportations, that's labor inflation. Reshaping the Fed in order to lower rates, that's inflation. The One Big Beautiful Bill Act, that's lots of spending and largely inflationary. I'm telling you, Trump wants inflation. Now, I'm not here to evaluate these policies for being good or bad. This is about policies, not politics. And understand, it's not just the U.S. government, it's every government everywhere that secretly wants inflation. And why do they want that? Well, first, it fuels spending. If you know that your dollars are going to shrink in purchasing power tomorrow, well, then you're going to spend today, and consumer spending makes up 68% of U.S. GDP. Yes, Amazon thanks you. Secondly, inflation shrinks the government's debt. The third reason that governments everywhere want inflation is because it foils deflation. In a deflationary world, people hoard cash like it's gold bullion, tax revenue dries up, and the economy stalls. And also, inflation, it facilitates wage adjustments. It helps the labor market function. If economic conditions are weak, well, then employers can implement real wage cuts just by keeping salaries flat right where they're at. I mean, that is so preferable to cutting nominal wages directly and giving employees a pay cut notice. Everyone hates seeing that. So those are 4 big reasons why governments will take their gloves off and fight in a steel cage match to the death to ensure inflation. So most expect a rate cut at the Fed's meeting next week, but if this continues and there were massive cuts, there's something else you've got to ask yourself. Do you really want to live in an economy where massive rate cuts occur? I mean, that's what the 2008 global financial crisis and the COVID pandemic in 2020 brought to us. So massive cuts mean there's some giant problem out there. Therefore, although the Trump and Powell rivalry, it might make interesting theater and headlines. Let's not get carried away. Let's put things in perspective. What matters to you more is how many dollars you're leveraging, the efficiency of your property operations, and the quality of your business relationships. Really, the bottom line is that Fed tweaks are background noise. Inflation, that is the long-term engine that makes your real estate profitable. Focus there and let the politicians keep doing the yelling. Concerns about ongoing inflation and what that means for real estate investors. That's next. I'm Keith Weinhold. You're listening to Get Rich Education. The same place where I get my own mortgage loans is where you can get yours. Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I mean, I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866.
This is Rich Dad Advisor Ken McElroy. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
We have a familiar voice back on the show. It's an in-house discussion here with our own GRE Investment Coach. Since 2021, he's helped you completely free, usually over the phone, learning your own personal goals and then helping you find the market that's the right fit for you and even help connect you with the exact property address that helps you win the inflation triple crown, like say 321 Mulberry Street in Chattanooga, Tennessee. They say that formal education will make you a living, self-education will make you a fortune. Well, he's got them both. He's slinging an MBA and he's an active real estate investor just like you and I. Hey, welcome back to the show, Investment Coach Naresh Vissa.
Hey, Keith. Pleasure to be back on.
Inflation is something that affects real estate investors even more so than it does the general public, since we're borrowing large sums of money. And the inflation discussion sure has been interesting lately. You just can't quite get rates back down to 2% still. They've been elevated for years. So talk to us from your vantage point about inflation and future inflation concerns.
Well, Keith, I am concerned about inflation. This is the first time in a year or so that I'm concerned with the direction and with the policy surrounding inflation. Here's why. And I brought this up when I was on your podcast in July. The current administration is not talking at all about the fact that inflation is rising. We saw the CPI, for example, hit 2.3%, which was four-year low earlier this year. And since then, inflation has gone up. That is concerning, that inflation is going back up without any rate cuts yet. It's gone back. I don't want to say gone back up, but it's gone up. And remember, the Federal Reserve inflation target is 2%. So we want to get as close to 2% as possible. And the number one issue in the 2024 election and the number one issue today is still the cost of everything is too much, which we'll talk about, from gas prices to home values to rents to Grocery, that's the big one. The cost of groceries, the stuff that you buy at grocery stores, etc. Everything is just too expensive. Of course, education, you name it, childcare, everything is just too expensive. Inflation is still, I think the administration needs to really tackle this problem. They need to really, really tackle it because it is the number one issue. It is what people essentially their vote is based on. It's not necessarily based on some peace agreement in a foreign nation. It's not based on some social issue. The number one issue is going to be this inflation problem. It's, are things affordable? Do I have money in my bank account to pay for X, Y, and Z? So I am concerned because yes, tariffs are inflationary. That's kind of common sense now. I think tariffs can be good. Tariffs can keep inflation in check if they're handled the right way. We will see that, but my bigger concern is that inflation has been rising. We're not anywhere close to that 2%. And we know with a very high degree of certainty that the Federal Reserve is beginning their rate cutting cycle next week with the September rate cut, and that's going to be extended. We've seen President Trump, he's very public, his Treasury Secretary, his Secretary of Commerce, all the economic advisors who he has, they're very transparent about the fact that they want rates slashed and they want rates slashed quickly. And so we know that we're going to get this is going to be a rate slashing cycle. It's going to be great for the upper class, if you want to call it. It's going to be great for real estate investors, but for the common man, the byproduct of that is going to be higher inflation. There's just no way that you can cut rates so quickly, so low, and you're not going to see inflation. That's my concern. Now, on the other hand, and again, we have to see how this plays out. On the other hand, I brought up earlier this year, I've referenced Doge. I think Doge is doing a good job cutting government spending, trying to scale back some of the government initiatives. Not that the government's always going to spend, we know that, but you need to cut back, and Doge is trying to do that. That's a plus. But even bigger, I talked about some foreign wars, right? Well, I think that the Middle Eastern conflict and the Russia-Ukraine conflict, both of those actually are disinflationary, or fixing those conflicts, creating peace. We've seen a ceasefire in the Middle East. We've seen a peace agreement in Ukraine, and they're disinflationary because of some of the items that I brought up. I think oil is going to dip below $50 a barrel as a result of these peace agreements, these ceasefires. So we're going to see oil prices go down. When you see oil and energy prices go down, you see the cost of almost everything else go down because you need oil and energy to transport everything else. If you're building a house, you have wood and steel and lumber and all sorts of materials, and you need a truck to transport all that. And the truck is it's not an EV truck. You're getting these big trucks that are using diesel fuel. So if we can bring down the cost of oil and gas and electricity, which taking care of these conflicts will do, creating peace will do, the price of those products, oil, the natural gas, the electricity, the wheat, the grains, those are your groceries. The costs of those are going to come down. So I think it's very positive what we're seeing with this idea of peace in regions that make a huge difference to the global economy. So I'm curious to see, I think we could see greater than 100 basis point decrease in inflation just by solving these conflicts.
1% or more.
I legitimately think so. And that's without the tariffs, that's without the federal rate cut. So even if we're at, let's say, 2.5% inflation today, and you shave off 100 basis points up, now you're at 1.5%, and then you throw in tariff inflation, you throw in the rate cut inflation, and we're around 2%. So that's the ideal scenario that the administration is hoping for. It's let's create peace, let's have a freer market, and then they can scale back a lot of these tariffs too, because many of these tariffs against India, for example, they can scale back. The United States can scale back the 50% tariff on India. That tariff was India got hit with because they're buying Russian oil. And you take care of the Russia conflict. Now we say, oh, India, we'll scale back to go back to your 25% tariff, or maybe even less if you do X, Y, and Z for us. We can expect to see many of these tariffs scaled back. We can expect to see the price of specific goods and services, the prices decrease, which will bring down inflation. That's what I'm optimistic about. Hopefully all these agreements hold, which I think they will, and we can expect that. And the Fed can begin its rate cutting cycle and everything will be booming and everything will be great. This is the ideal scenario. I'm not predicting this. This is the ideal scenario for the administration.
When both war and tariffs get as bad as they can possibly get, from there, they can only get better, each of which would be disinflationary. Now, the CPI inflation has been reported at 2.7% each of the past 2 months. But when we talk about rates, Trump wants lower rates, of course, and I think we all know that the Fed's fear of lowering rates is that high inflation could resurface. One thing, though, that few think about is that lower rates lead to higher inflation, which kills off the national debt faster. But when we think about upcoming Federal Reserve rate cuts, anytime, whether this was 10 years ago today or 10 years into the future, these are the type of lessons that I like to talk about. All right, when we look at the last Fed meeting, there was no rate cut, but then awful jobs numbers were reported right after that. That's why some think that there could be a 50-point rate cut at the next meeting. The Fed meets 8 times a year, so there's about a month and a half between meetings. Now, the Fed doesn't have to wait for a meeting to make a rate cut. They can do an emergency rate cut between meetings like we saw during COVID, but sometimes they're reluctant to do that because that really spooks markets and that makes people think, oh my gosh, there was an emergency rate cut. Maybe things are worse than we thought. What's going on? That triggers concern.
Well, I think that would be a huge mistake to have an emergency. The
Yeah.
pandemic was obviously an emergency. That was a global emergency. Makes sense. 2008, I remember I was just a college student, but that was an emergency because we saw people lining up on the streets of Manhattan with all their boxes of laid off work. And we saw that on TV. That was a trying time. I think that's out of the question. It's completely unnecessary, especially when the Fed meets every 45 to 50 days. It's, you can wait another 20 days until the next meeting and then make a decision. When you have lower rates, then the borrowing cost on the debt, it goes down. So the government can refinance its debt and they would pay fewer interest dollars. That's a plus. The other plus is with tariffs. And I really hope, again, this is just my opinion, I hope this is what happens, but the government is raising quite a lot of tariff revenue, so close to $30 billion last month, and we can expect in the first full year next year, it's going to have raised close to $500 billion just for fiscal year 2026. That's the expectation, about $500 billion worth of tariff revenue, and I hope that the government uses that tariff revenue to pay down the debt, because when you're paying down the debt, you're dissipating inflation. What I actually don't want them to do is to give us back that money, because they've been floating that around saying, oh, we got all this tariff revenue, let's get it back as a tariff dividend, and every American gets $100 in their bank account or something.
Very altruistic of you. Patriotic.
I would much rather that they use 100% of it to pay down that debt, because the country is going to be better off as a whole over the long term. And in turn, the people will be better off over the long term. The people may not see it. They may want their $200 check or $100 check or whatever it might be. But over the long term, I think the tariffs are overall working out quite well. We're not seeing the crazy inflation that the mainstream experts predicted. I don't think we're going to see the crazy inflation that the experts predicted. If we do, it's not going to be because of the tariffs, in my opinion. I think it's going to be if there's this aggressive rate cutting cycle that juices the markets and the cost of everything just goes up. And this ties into real estate investing, because when the Fed starts cutting, that's a very good time for real estate investors to pay attention. When the Fed stops cutting immediately, that's an even better time to pay attention, when the rates have bottomed. And this has to deal with timing the real estate market. I'll give you an example. I own several properties. One of my properties, when the Fed was cutting in 2020, it took about a year for all those cuts to permeate into the mortgage market and into the market as a whole. It took it. The inflation didn't go up overnight. The inflation didn't go up in April of 2020 or May of 2020. It went up in April of 2021. It took about a year. So I actually refinanced one of my properties in July of 2021. I refinanced my property and I saved about 110 basis points on that refinance. And that's what I mean by timing the market, because if you're paying attention part of it was I knew, okay, the Fed has stopped its cutting, and let's follow the mortgage market, let's follow the treasury yield curve and all that. And I jumped in. I literally refinanced at the bottom, like at the absolute bottom. There was about a 3-month window that was the bottom, and I refinanced. I did the application, all that at the beginning of those 3 months, and I got that great rate at the end of those 3 months. And I think there's going to be a tremendous opportunity for real estate investors. And I'm sure this is why I'm a little concerned about inflation as well, because the big hedge funds, the big real estate investment firms, the big banks, the Blackstones, the BlackRocks, they're going to be ready and they're going to buy up. They're going to buy up real estate again. And investors, including our GRE investors, they're going to start buying up too. So pay attention. We're going to cover it here. We're going to cover it here on the podcast and in the newsletter, but pay attention to these rates because it'll be, I don't want to say a once in a lifetime opportunity, but it will be a once in a cycle type of opportunity to jump in and get some bottoming real estate values as well as bottoming real estate mortgage rates at the same time. So that equilibrium point is only, like I said, about 3 or 4 months long. So we're going to be coming to that point and timing it sometime, I think, next year, 2026.
Talk to us about the vibe that you're getting from GRE listeners that contact you for a free coaching session. It's really hard to time the real estate market. Why don't you help us out with that? Let us know about a listener or two that you recently helped.
Well, we have free real estate investment coaching here at GRE. It's absolutely free of charge. You can call, text me, email me whenever you'd like. People can book a free meeting with me. And it's a session. It's an immersive session on real estate investing. So we can go over all of that on our call. You can reach out to me unlimited times. Like I said, I'm here just to help you throughout and along your real estate investment journey. I've helped hundreds of people invest in real estate, hundreds. So it's buying turnkey cash flowing real estate properties. So our investors can buy properties and use my guidance and advice to help them buy properties. I also help them, if they already own properties, how to optimize their portfolio, how to find new markets. I help them with their existing properties, dealing with property managers, with contractors, even with issues. Things aren't always great in real estate. Sometimes things can be bad. So listener Paul, for example, he had a problem with the builder and he submitted earnest money and he wanted his earnest money back. Many, many years had gone by. And he came to me and he said, "Hey, Naresh, I've got all this money tied up and the builder's not giving me the money back. Can you help me?" And so I got him in touch with the right people. And within 3 or 4 months, he got all of his money back plus the interest on all the missed payments. So he got everything back as a lump sum. And then he thanked me and said, "Thank you so much. I can sleep better at night. And I'm doing very well now." And he was ready to buy his next property.
That's an example of where a deal went wrong and the builder didn't perform and build a property.
Yes, exactly. Think of me as a trusted advisor, but also as a super connector, someone who can get you in touch with all the right companies and people to make real estate investing very sound. We have listener Joe who bought many properties through us. He bought his first property through me and through GRE, through our coaching program. And that first property worked out really well. So then he said, "Hey, I want to buy a second property," about 6 months later. So he bought a second property and that worked out well. And then he said, "Let's go with it." And he bought all these with the same provider. So once he reached 4, because my rule is you don't want to go more than 4 or 5 in one market. Then he asked me for the next. He said, "What market do you recommend next?" So then I recommended the next market. And then he bought another 3 or 4 in that market. And he built a nice little portfolio of 7 or, some people think it's little, some people think it's big, 7 or 8 properties. So that's very common with the coaching program where our listeners are really happy. If things are going great, I'm here for them. If things are not going the way that they expected, I'm here to help fix that problem.
Naresh is there to help you start building and grow a portfolio. Now, how do you yourself analyze deals and find properties before you let our listeners know about them?
Well, we work with 15 to 20 different providers around the country, 15 to 20. So these providers are always reaching out to me emailing me, calling me, leaving me voicemails, texting me, saying, we've got this great deal, we've got this great incentive. So I parse through all of that and I find a handful of what I think is best. And many of these deals, I send them to you, Keith, to promote in your Don't Quit Your Daydream newsletter, which people can subscribe if they go to getricheducation.com. I send them there and I let our listeners know on the phone when they set up calls, or I have notes on every meeting. So I'm able to send all of these deals to them, and that's how I put the best deals in front of them.
Most of the coaching calls are over the phone rather than Zoom. Naresh sure can arrange a Zoom call with you if you prefer. You really don't need to do too much to prepare for the call either.
No, not at all. Just sign up for the meeting and I'll run things. I'll run the meeting. I'll run the call. It's very straightforward. It's a session. It's very immersive, very interactive.
Yeah, and you just have to book a time with Naresh once there, and afterward, yeah, it's really casual. Naresh is very open to you text messaging him if you have any ideas or if you just heard about something on the show that you want to know more of. But yeah, booking that first coaching call is really what opens the door to the communication and you really staying up to date on things. You can find Naresh through GRE Marketplace, and alternatively, you can learn more about him with his bio and importantly, book a time on his calendar by going directly to greinvestmentcoach.com. For a while now, he's had times available Monday through Friday and even some weekend slots available. And yeah, keep in touch with him because property inventory is ever changing, especially with late breaking news like we've had this year of home builders offering major incentives like buying down your mortgage rate to about 5%. So staying up to date has hopefully brought you, the listeners, some really big wins already this year. Naresh, do you have any last thoughts?
Definitely book a meeting with me. You won't regret it. I think even if you think that you own all these properties, you have all this experience, I think you'll find that the resources we offer it through our free coaching program, there will be one or two nuggets that you didn't know about that will still help you. So it doesn't harm anybody to book that free session with me. If you don't think you need my help, maybe it's just a 5-minute call and we touch base and we're good to go. That's fine too. But I highly recommend that people get in touch with me. We go from there so that you can continue to have a fruitful investment journey.
Naresh, it's been valuable as always. Thanks for coming back onto the show.
Thank you very much, Keith.
Yeah, some sharp insight from Naresh as always. Now, when you think about making your next property move, consider how, compared to a few years ago, uncertainty has largely abated and real estate has stabilized. Think about how back in 2020, COVID was the big uncertainty concern. 2021, it was this real estate boom and an inventory shortage. You would get 50 or 80 offers on one property and buyers were waiving inspections. That was tough. That was such a seller's market. In 2022, that's when you had inflation and the supply chain chaos. That's when CPI inflation peaked at 9.1%. In 2023, the big uncertainty concern was interest rate shock and the affordability crisis. And last year and this year, they've pivoted more to macroeconomic concerns. So therefore, today's chief concern, it's somewhat more buffered from real estate. Now, I discussed the direction of rents earlier in today's show. The recently released Case-Shiller numbers came out, and they showed that national home prices are up almost 2% annually. 13 cities are higher, and 7 are lower. And by the way, this continued nominal price appreciation, that frustrates the bejesus out of those perpetually wrong crash predictors. They have been wrong even longer than the people waiting for flying cars to show up. And where will prices continue to go from here? Probably even higher. Now, America just hit somewhat of a milestone. In this cycle, you might remember that mortgage rates peaked at 7.8% almost 2 years ago. Well, mortgage rates have now slid down to 6.5%. And here's why this has become significant. All right, just compared to when rates were 7% per the NAR 2.8 million Americans now qualify to buy a home. 5.5 million more will qualify at 6%, and 7.7 more will qualify at 5.5%. My gosh. Now, of course, not every newly qualified buyer is going to pounce on a property, but only if a fraction of those do. Can you imagine how this demand increase will stoke prices? There are still only about 1.1 million homes available today. So not only are mortgage rates at a fresh low, but inventory choices, although they're still historically low, they are now at a 6-year high. And this is all while there's less buyer competition. So today's buyer conditions are really improving. And the bottom line here is that you are in the best position in more than 5 years to find the right property while still avoiding a bidding war. You have really got some properties to choose from. That is the takeaway. And you don't need to do much to prepare for an immersive free call with Naresh. You know what your situation is, although you probably do want to have about a 20% down payment for a property ready to go, some of which cost as little as $200K in these investor advantage markets. Whether you've never bought any property in your life, or if you have dozens, it probably will benefit you. You can easily book a time that works best for you right on a GRE Investment Coach's calendar. That way there's no back and forth, and you can set it up now, should you so choose, at greinvestmentcoach.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
You know, whenever you want the best written real estate and finance info, oh, geez. Today's Experience limits your free articles access, and it's got paywalls and pop-ups and push notifications and cookies disclaimers. It's not so great. So then it's vital to place nice, clean, free content into your hands that adds no hype value to your life. That's why this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point because even the word abbreviation is too long. My letter usually takes less than 3 minutes to read, and when you start the letter, you'll also get my 1-hour fast real estate video course. It's all completely free. It's called the Don't Quit Your Daydream letter. It wires your mind for wealth, and it couldn't be easier for you to get it right now. Just text GRE to 66866. While it's on your mind, take a moment to do it right now. Text GRE to 66866. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.